Ed Yardeni's saying he doesn't mind if the Mag 7 do nothing the rest of the year. I think a lot of other investors would. But let's just pull on that thread just for a minute. Let's say we do see a major rotation out of tech. What sector do you see being the biggest beneficiary?
Yeah, I think if we're seeing it because rates are coming down and the expectations for a Fed cut are moving higher or being pulled forward, then it's the cyclical sectors of the market, right? And you have to look at ones, in my opinion, that also have some structural tailwinds. We've liked industrials for a while on that front. So I think you've got a cyclical trade, the economy holding in there, structural tailwinds in the form of fiscal spend, aerospace and defense spend. So something like industrials, I think, with a diverse industry backdrop has a chance to outperform.
All right, so yesterday we definitely saw a rotation. For example, biotech, the IBB ETF finishing up almost 2.5% higher. Biotech's been under a lot of pressure this year. And as we mentioned earlier in the show, small caps having a very good day, especially compared to the S&P. I do want to ask you a bit more about small caps. If we continue to see this rotation in the small caps, in your mind, what does that say to you about the strength of this market overall? What does that say to you about investor confidence in mega cap tech?
Well, I think it's a lot less about mega cap tech, right? Maybe a little profit taking, a bit of a breather after a historic run. But the fact that we're seeing a rotation into equal weighted S&P, into small caps, signals a confidence in the economy, right? You're not rotating into those parts of the market unless you're confident in the economy that when we get rate cuts, that rates coming down are not a negative for growth, that they're not giving a negative message on economic growth, but rather are signaling that inflation is coming down and the soft landing is still in play. So totally fine, as with Ed Yardeni, that tech is taking a breather, especially because we're rotating into something a little more cyclical, a little more rate sensitive.
So Ross, very quickly, I just want to push back a bit. So if the economy remains strong, would that also benefit those mega cap tech names as well?
Sure, absolutely, yeah. I think the thing is you're getting a breather here, not a total deflation of AI enthusiasm, right? Now, the big tech, they're not as rate sensitive, right? They're cash rich, they're low debt, so they're not as rate sensitive as long duration tech. The equal weight tech has really underperformed cap weighted tech here. So I think if you get a rotation into other parts of even the tech sector, that says the same story.
All right, Ross, one last question. I was speaking to a managing director of one of the big banks. They said since the jobs report, they've seen a big flurry of long duration bond buying. A lot of people trying to lock in those longer yields. Is that something that you would advocate for your clients as well, to take advantage of those higher yield bonds now while they last? Because obviously, not obviously, but it seems like we're pushing closer and closer to a rate cut.
Yeah, I think so. Our wealth management clients have been loving cash, loving money markets, the 5% you can get there. But I do think the days of that are numbered because, as you mentioned, rate cuts are being pulled forward. So I do like locking in a little bit of duration. If you've loved these rates, and I don't think we're going back to zero by any means, but if you're liking these high rates, I think locking in long duration makes a lot of sense. I would keep it high in quality, whether treasuries or some high quality corporates. But yeah, I think that makes all the sense in the world.